How can you achieve more bang for your buck? Stay with me and we'll find out. Welcome, fellow investors, to this presentation on how to get more bang for your buck. It's based on Harry Markowitz. Like so many things, he was an economist, US economist, who revolutionized the financial industry with his approach. He got a Nobel Prize for that as well, by the way. How to manage your portfolio, how to set up your portfolio, and how get the best out of your portfolio. How do we define best? Best in terms of risk versus reward. Reward, easy to explain, yeah, it's the return you are looking for, and risk is the volatility of the market. By how much is this return deviating to the upside or to the downside? And he was the man who put it all into formulas, showed us how it works, and has revolutionized the whole financial industry. Because even if fund managers or asset managers or wealthy people did it intuitively at the beginning and aimed for something, he was the first one to actually formalize this whole approach and make it, well, approachable to all of us, and that's what we're going to talk about today. You already see this lovely picture where I have a possibility cloud of assets we are mixing, but don't worry, I'm going into that in a second. Who am I? Name is Thorsten Roland Wegener. I studied law and economics in Berlin in a different time in the last century, and started my career as a market maker at West LB, which used to be the third largest bank in Germany at the time. Rose through the ranks, became chief trader, then head of trading for warrants and structured products. Eventually I moved to England and set up the equity derivatives business at Penmuir Gordon, which was a nice, smart investment bank, which West LB, the company I was still working for, bought at the time in London, and eventually moved on to become a partner at Bear Stearns, where I retired from the industry. So now you know everything there is to know about me. Oh yeah, by the way, I was also, how do you call it, a housekeeper, a housemaker for my whole family, an Uber driver, and apparently, as I still love working, I'm writing articles, give lectures, and apparently I'm doing YouTube videos. So I've called it Fractal Portfolio Management, and it's concept of advanced wealth management, and we are in part one. Why fractal? Because we're working from the little bits to the larger bits, and we can do that because markets and so many things are by its nature fractal. What does it mean? I can derive out of the little things the bigger picture, and that's what we're trying to achieve today. So, the agenda for today is very short because that's only the first part. I was told to keep it short and snappy on YouTube. We are looking into the portfolio construction, the asset classes that are available to us, and then into the most important topic, diversification. Risk-reward management without derivatives. I mentioned it, I was an options market maker for 15 stocks in Germany, but today we are not playing any short games, we are not doing any exotic derivative structures. We are really trying to just approach that from the perspective of what do I do as an investor? How can I get better rewards for the risks I'm willing to take? So, the building blocks of professional wealth management. This is a slide I have, you see, Option Macro Bootcamp. I'm teaching in Germany, in German, students in, well, how to improve their performance in markets, how to understand all the things that they try to explain here at university, but keep it a little bit, make it a little bit too difficult. So, as a practitioner, that's my way of approaching it, with my own portfolio as well. We start in the macro world, yeah. Then we look into the fundamentals of the market. Then we look into the technicals and market mechanics. We have our trade selection, yeah, and how are we going to do that? I have something, videos unfortunately only in German at the moment, a macro playbook, yeah, and we look into sector rotation we see in the market to get an idea where are we roughly in the economy. Yeah? Stock market is usually a little bit ahead of the economy, but we need to get a broad picture. Why? Because everybody else does it. Huh? It's very easy to make money in the stock market. You just have to do what everybody else does, just a little bit earlier. Having said that, let's press on. Red, financials. Yeah? one of the most important things, if you really want to invest your money into a good company, you should have a look at the numbers, you should have a look at management, but that's not what I'm teaching. That is something where more qualified people are out there. Shout out to my friend Anand, who runs a hedge fund in Hong Kong, used to be one of my former colleagues. And then obviously I want to have a look at insider transactions, not the evil insider transactions, Wall Street style, the good insider transactions. Yeah, people who work in a corporation, obviously by the nature of their job, know more about how the company is doing, and they vote with their money. Very reliable. If you get the tops and the rights, where the high volume knots are there, they're interesting for us. Then we look at everything we can see in the market. You have a TradingView subscription or whatever you're using. You can look into the volume that's been traded. You can look at open interest if you have a broker account. You can pay vendors for a look into the gamma distribution, an important concept. And obviously I always employ, I've called it the diverse. These are the higher Greeks from Black and Scholes, which can give us fantastic ideas where we are temporarily in the market, where there's a stop or where there's something which is of particular interest for us. We go into the trade selection. We have to define our risk profile. We look at probabilities of making profit, a statistical model. We look at the implied volatility rankings out there, important for option trading. And then we actually follow up with active trade management for each individual trade. It's not just a fire and forget missile where you put it out and don't do anything. The next step is you are active in markets when you know what you're doing. So, and all these trades, all these ideas we develop are obviously part of a portfolio management approach. We have a risk profile for our portfolio. Then we optimize what we all put into that portfolio, and that's the topic of this presentation. Important for the sizing of our risk. And then we don't fire this portfolio up just once and then don't do anything. Whenever there's a necessity to approach something, we will do that. Otherwise, we'll stick to the plan. Very important. So the optimization is topic of today, and how can we approach that? I've called this the process because there are so many snake oil salesmen out there who are selling investment processes and you name it, that I thought, yeah, I do the same. So if you just take the letters from the first letters, we start at my process. Portfolio construction. Let's have a look at the asset class first. Where can I invest? And there's obviously a smorgasbord of possibilities we have in here. I've asked the good people from Grok, because I'm naturally lazy, give me the biggest asset classes and the returns over a very long term, and the volatility annualized obviously as well over a very long term, and the correlation. How do these assets trade in relation to each other also over very long time period? And Grok chose here 10 to 20 years. So I think we're on the safe side that at least the statistical models Grok put in here for me are all right. Obviously, if you invest for yourself or you're a professional, you do your own work. You always do it. Sometimes these things make mistakes, and you have to check them out. So what can we see here? Cash, 10-year annualized return of 1.82% and a volatility of 0.54. What does that actually mean? It means on average, if you put your money in cash, short-term treasury bills or something like that, you made 1.82% a year, and the fluctuation around this mean was 0.54 to the upside or to the downside in this corridor, with a probability of roughly 70%, the so-called famous first standard deviation. See that, for example, here in equities. Over the long run, over the really long run, we have about 7% in equities if we take the S&P as a proxy, but for the last 20 years, we're almost at 10%. So 10% annual growth rate, but we can, within this 70% probability corridor, trade much higher, plus 15% to the upside, let's say 25%, or minus 5%. And that happens within roughly 70% of the time, that we're somewhere in between. If we go further out, which is the absolute possibility, that would be then 2, 3, 4, 5, 6, 7 standard deviations. But the broader this corridor gets, the less likely it becomes. But it happens. So this is the stuff we're going to put in our portfolio, and that's where we have a starting point. So how does a portfolio actually should look like? I there's a fantastic little website. It's called portfoliocharts.com, and you can get a rough idea about all sorts of portfolio mixtures somebody invented, back-tested, played with it. I can only recommend to you, do your due diligence, get an idea what would fit your investment style or what you want to achieve. I'm just pointing out two classic portfolios, 60-40, equities and bonds, or Ray Dalio made this famous, the all-season portfolio. What would you want to invest if you don't really care? Maybe that's exaggerated, but you don't know whether we are in front of the next recession or the super hyper bull market or something tremendous worldwide. So you want to be prepared for all situations, and you don't want to be eaten up by this volatility, by this big deviation around the expected return we calculated from past numbers. So why do we do this? We want to balance risk versus reward in our portfolio. And there's a way of doing this. And I prepared an example where I said, let's assume we have three assets we can choose from. Asset A, B, and C. And you can see here, asset A has a return of 9%, that's on this axis, and volatility of 12% around it. Asset B has a return of 12% and a volatility of 15% around its mean. And asset C, 15-15. 15% return, 15% volatility around it. So that's where the fractal approach comes in. First of all, you are choosing from past data or from your expectations something which will offer a reward with an associated risk. Whether that is Coca-Cola or a specific trading strategy your commodity trade advisor has developed, doesn't matter. These two numbers are interesting for us. Risk, the volatility, and the reward. The assets themselves are interchangeable as long as your assumptions for these returns stand the test of time. Well, easy said, but that is the first approach to say, I don't actually really care what asset I put in as in my portfolio, as long I have a reasonable idea how should the future reward be and what volatility am I willing to take. Then it doesn't matter whether you have asset A and asset B, they show exactly the same numbers. One is a high-tech stock and the other is, I don't know, utility. Obviously it doesn't make sense, that example, but you know what I'm talking about. So, and I can mix these. I can, for example, say I put 100% in asset A and 0 in asset B and 0 in asset C. Or I can say I put 10% in asset A and I put 40% in asset B and 50% in asset C. And each one of these green little dots represents one of these mixes. And there's a finite amount how I can mix it. I can have 100% in asset A or in asset B or in asset C or a mixture out of that. And all these mixed portfolios give me a different return and a different risk portfolio. And obviously the question we are talking about today is, what's the best portfolio? How can I mix that when I have certain assumptions about the future returns and volatility of assets A, B, and C? So how much should I buy to actually have a pretty high return or a very low volatility or a higher volatility but a higher return in that? So one of the things you can already see here, I cut this chart in half of the possibilities. There are two portfolios, a green portfolio and a red portfolio. So both of these portfolios have a volatility of, let's say this is 10.5 here. That means the risk, they are fluctuating around their return. However, same risk, but the green dot has a higher reward. How can we achieve that? By mixing the portfolio in the right way. And we can already eliminate everything that is below this line. Obviously, it doesn't make sense. Why would I, when I take the same risk, go for this portfolio, when I can take the risk of the red portfolio but get a higher reward for it? So the first selection criteria. How we go to that, I'll explain in a minute. This was a correlated portfolio. What is correlation? If one stock, one asset goes up, the other goes up as well. Most of the time, not all of the time, but correlation is there is a connection between the direction they are moving in. It's not by how much, that's so-called beta. I've heard about that as well. It tells you in the past, if stock A moved by 1% up, then B moved by plus 0.7% up or by 3.5%. Correlation simply tells you, is there a relationship when one stock moves to the upside or the downside in relation to another asset we have in here. And the easiest example you all know, if you buy high-tech stock A, B, and C, and high-tech goes through the roof, they all move pretty much in the same direction. If A goes up, B goes up, C goes up. So they have a correlation with each other. I already see the first point. Sometimes you think you have a portfolio with a lot of companies in there, you're well diversified. Well, if they all go up at the same time or all go down at the same time, you're not diversified. You have a little bit of a benefit in there, but you basically have the same position over and over again. There's one position in your portfolio. So, and this was a portfolio where asset A, B, and C have a certain degree of correlation. It doesn't matter how much that is, but they are correlated with each other. Okay, what is my first step? How do I get fractal? I have in my plan a portfolio which I say at the moment it should only be 3 assets, and I want to have a return with asset A of around 15%, asset C here, and a volatility around 15%. As I said, that could be Coca-Cola, or that could be a strategy you play in the option market or on the oil market or whatever. Then you say, I want to take asset B, to get something else in my portfolio with the same return risk profile I have in here, and the same is obviously true for asset A. However, what I've done now, I said, okay, check the correlation between these assets. I do not want asset A to move in the same direction like asset C when markets go up or down. I don't want asset B to move into asset A's direction if market goes up or down. I want to have them, that's the word, uncorrelated. It doesn't matter how the return of asset A is for the movement of asset B or asset C. So that is the uncorrelated portfolio, what we're trying to achieve. And why do we want to achieve that? Again, the only thing I've changed in these 3 assets is the correlation, how they move with each other. And suddenly I have another possibility space here. These are the gray dots. What can you see here already? We can see here it's roughly on the plane of the returns on this side, but the risk has dramatically been reduced. Where we had here a risk of, let's say, 9.5%, we can get that down to just 8% by only removing correlation only. By removing correlation out of our portfolio. So I could say, for example, I have here a portfolio which is from correlated assets. They seem to move in the same direction most of the time, or the majority of the time. And I can have a portfolio of uncorrelated assets where asset A is not bothered by asset B or asset C's price direction. Obviously, I still have to have a good idea why I want to own these assets, but they should not be related too much. They should be uncorrelated. What you can see here already is the same. Wow. Just by removing correlation, I have the same return of 12% for this portfolio and for this portfolio. However, this portfolio deviates by only 8% around these 12% returns, and this deviates by almost 11% around the expected 12% return. So if you have the choice as an investor, what you do, obviously, don't have to explain it to you, you'll go for the uncorrelated portfolio, which offers the return of 12% while taking substantially less risk. We've reduced the risk by 25% in this approach already, just by picking uncorrelated assets. So, then obviously we can see something else. We have here all possibilities in green dots, but there is one spot really far out to the left, if we look at the volatility scale, which has the minimum volatility. So I can mix my portfolio in a way that the volatility of this overall portfolio is the smallest possible. And it's called the minimum variance portfolio. And I can obviously do that for the uncorrelated portfolio as well. And if you see the charts, here we are at a risk level of 9.79, and here we are at a risk level of 7.95. So I've taken massive risk out of the equation. This is the best I can get in terms of I want to buy risky assets. Obviously, that's why we're doing this exercise. But that's how much I can reduce my risk if I'm restricting myself to these assets I've chosen before. In our case, 3 assets. So we can already see if we compare it, minimum variance portfolio, I can get a lot more bang for my buck. Now finally can slip it in for my uncorrelated portfolio than for my correlated portfolio. Obviously, we have to look at the numbers, at the figures, and simply say, okay, on the left side, I have the returns, and on the right side, I have the volatility. Equities correlated portfolio is green. Simply says 12% return corresponds with 10.86% of volatility. Then we have a minimum variance portfolio correlated here, corresponds to 11.13% return with 9.79% in volatility. And the uncorrelated, beating it out of the water here, uncorrelated portfolio 12% return, but only 8.12% in volatility, and the same true for the minimum variance portfolio for uncorrelated assets in light gray. So next step was obviously I simply went in there and said, okay, let's divide one by the other, because it shows me how much return per point of risk I'm getting here. And what you can see here is the equity portfolio correlated is beating by a tiny margin my portfolio of uncorrelated assets, right? So why is that the case? We'll come to that point a little bit later, but it shows you simply that the whole uncorrelated portfolio here seems to have the better risk-reward ratio than the correlated portfolio. We are in both cases better. Obviously now here our portfolio from uncorrelated assets has a higher ratio out of that. So, but forget that ratio for the moment. It's simply to get the idea through to you. Each point of volatility gives me a certain point of return. I can get that. The higher the return is in terms to the risk I'm going to take, the better it is for me. The question is, can we do better? And obviously, if I ask that question, we can do better because we haven't introduced one thing yet. That is the so-called risk-free asset. What is a risk-free asset? Risk-free asset is, let's say it's a government bond. It will always pay back what they promise you it would pay back. There's inflation and everything, but that's not the concern at the moment. You will get the money back you originally invested in it. And for this purpose, we say this risky asset has a return, and I could say at this level of interest rate, I can borrow money and I can invest money. Obviously, in reality, there will be spread in between, but I want to make a point here and explain if that is very close together. Let's assume you're an institutional fund manager. The spread isn't too wide. You're a rich, high net worth individual. They will give you money not too far above the rate where you can invest money, as long as we're talking about risk-free yield. Get your money back in any time. So, and this is simply the line. I said for our example, the risk-free rate is at 4%. And what I'm going to do, I'm connect that to this portfolio of possibilities I have in here. Why I'm going to do that? You can already see we are here at 4%, and I'm just ever so slightly touching the cloud of all possibilities I have in here. And that is a portfolio which will offer me, now I have a risk-free rate, the maximum performance I can get out of a mixture of different assets when I'm willing to take risk into my, e.g. volatility in my consideration, while being able at the same time to either borrow money or invest money. So this Sharpe portfolio has a performance of 12.7% and a risk of 10.74%. Yeah? We started with these 3 assets. We had a minimum variance portfolio here. We had a random portfolio there. And we said, okay, how can I get the most bang for my buck out while we introduce, there is something which is called the risk-free asset. So at this point, I would have invested 100% of my portfolio with a mixture of percentage A, percentage B, percentage C into this point converted. Why does that get interesting now? Because let's just think about it, what could happen. I could say I'm investing 0% in a risk-free asset and I'm investing 100% in a risky asset, my portfolio. So the next step would simply be, I say, what if I'm risk averse, I'm investing 50% in a risk-free asset, a government bond, and 50% in the risky portfolio. I look how much I should invest in each asset, and then simply do half of that, keep the ratio straight, and half of the money goes into a bond, risk-free. So that means I can now, on each point of this line, decide how I want to be invested. In this case, say, here I have 100% in my risky portfolio. At this point, I have 0% in my risky portfolio and everything in bonds. If I mix it up 50-50, I can get a return of 8.35% with a risk volatility of 5.37%. I can also go a bit nuts and say, okay, I'm borrowing money now. I simply say, fine, I'm willing to take more risk, more volatility here. So I borrow money at 4% and put that all in this portfolio. So instead of now having 100% in my portfolio, I have another half put on top of it, which I have financed with other people's money at an interest rate of 4%. That's the so-called leverage, and that's the game of the financial industry, how you get higher returns. But we're not doing it blindly. We're not just investing here. We run it through a process and say, if my assumptions are right about volatility and what I expect in the future, then there is only one way to get the max out of this, and that's portfolio construction we have here. So 100% is my complete portfolio if I have 15 bonds and 50 in this risky portfolio. However, we were talking about an even already better portfolio, the uncorrelated portfolio. We always start at 4%. That's a risk-free rate the market gives me. But you've already seen we shifted in the first process by picking uncorrelated assets, trading strategies, you name it, for our portfolio. Then we went through an optimization process, which Excel does for you, or any website. There are a couple of them out there. I'll go into that in a second again. And then we can still connect the capital market line here to where we just ever so slightly hit the edge of this portfolio. So you can already see we've done two things. We've chosen the uncorrelated portfolio. We started with a risk-free rate of 4%, and now we just want to touch it here at this point. And then I can do pretty much the same game again. I can decide how much money do I want to hold in a risk-free asset and in the portfolio, and or do I want to borrow money and invest that in this portfolio. Then obviously leveraged up is the word. This would be then my perfect choice, my maximum Sharpe portfolio we have in here. For example, here I'm increasing my risk by borrowing more money. I'm here on this line because I've mixed it as if I would be here on this portfolio. I've taken more into assets into my portfolio by leveraging the whole thing up. And you can see here, if I would have just randomly picked the portfolio in this cloud, whatever cloud it is, could be the green cloud here or could be the uncorrelated cloud, I still have a risk of 10.74, but while using the factor of either borrowing money or investing money into a risk-free asset, I can improve my risk-reward ratio I have here. Now I have a return of 14.4% with a risk of 10.74% in this example. So, and now we're coming to the point I've mentioned a couple of times before, the Sharpe ratio. One of the biggest numbers in our industry people look at. What is the Sharpe ratio? The Sharpe ratio formula is here. The return of your portfolio, let's assume it's 20%. And then the return of the risk-free rate, the asset which always pays out. Obviously, if something always paid out and there's no risk that it will default, you get less money for that. You have to buy reward with additional risk. There's no way around it. So I deduct this from what my portfolio, the three assets I picked and mixed up, and say, okay, they should earn me 20%, and you get at the moment 10% risk-free rate. I'm just doing it for easy math, easy numbers. So obviously that leaves a net return of 10%, and I simply have to divide that through the volatility we just calculated that our portfolio gives us. What does it show us? It just shows us how much every point of volatility delivers in excess return over the risk-free investment rate. And then the game looks different. If we are going in here, equity portfolios, the correlated portfolio has 0.74, so every point in volatility gives you 0.74 points in return. If we go to an uncorrelated equity portfolio, every point in volatility I'm willing to take gives me 0.98 points of additional return. The minimum variance portfolio here, I've reduced the volatility completely, and if I consider, like we've done with a line chart earlier, that I can borrow and lend money, I can improve that. So if you are willing to invest, Sharpe portfolio of uncorrelated assets, you can see, has a Sharpe ratio of 1, which means every point of volatility I've taken, risk, gives me an additional point of return. So that is what I want to have. When I look in these portfolios, simple approach, how much would be my risky portfolio producing in performance? Then I subtract the risk-free performance from that. And then I say, okay, my portfolio, what do I expect? How is the volatility around this mean, about this average I have? And by dividing it, I have simple calculation where it tells me, yes, I want a very, very high ratio there. And 1 is already okay. The S&P can trade anywhere between, well, even negative, when we have a negative here, to 1.2, 1.3. Or if you have portfolio managers out there who really gifted in their skill set, they have Sharpe ratios of 1.5, 2, 3, 4, 5. You can imagine, but always ask, is it valid what we are seeing here? And if the Sharpe ratio is too high, always try to sniff out, is there something I have overseen? How are they calculating it? One of the tricks in the industry, especially for smaller, more aggressive hedge funds, was always calculated once a month. So you don't have the whole swings in there. So your volatility is smaller if you just look at it on a monthly basis. And they're understating then the risk they are taking. When they're understating the risk, they're overstating their Sharpe ratio. Makes it very attractive for potential investors. You can pause here. That's the math behind it, because that's what you can plug into your Excel sheet in the optimization process. But there are plenty of websites out there where you say portfolio optimization, just Google it up. You give 3 assets in, and then it automatically calculates you how much asset A, B, or C you should buy in your portfolio. We're only talking long-only portfolios at the moment. How much should I invest to be on this really beneficial edge of the cloud of possible mixes I have, taking into consideration there is something like a risk-free rate. So that's end of part 1 of Fractal Portfolio Management. Obviously, I held this presentation many times in Germany. There will be a second part, which I call the mini workshop, where we're doing exactly that, what I showed you today, as the background of things that are possible. And you always have to start somewhere. So we are going to pick real assets, doing the optimization process, trying to build it up, see how our Sharpe ratios will be, and where we should add or subtract assets if our assumptions for the future have a given point. How much risk am I willing to take? How much profit do I want to make? So, thank you for your attention. If you like this presentation, please like, share, and comment. And obviously, I have a recommendation reading lists always at the end of my presentations. Jack Schwager, the author of The Original Market Wizards, that's one of the lesser-known books, but I think it's actually my favorite because it talks about that, diversification, risk, unique approach, then a random walk down Wall Street. If the markets are random, and Eugene Farmer got a Nobel Prize for that, to say, yeah, markets are random. And if we believe in that, then a classic, a random walk down Wall Street, whatever portfolio manager tells you how they can pick assets, doesn't matter. What matters is how you construct your portfolio. Because if it is all random, then we can get an edge out of structuring our portfolio in the way I just demonstrated to you. Simply complexity, and the classic Benjamin Graham, The Intelligent Investor. If you already want to dive into options, that is my, go-to book. Somebody dropped it on my desk the first day I started working on a trading floor. Sheldon Nadenberg, Option Volatility and Pricing. We will come in a further stage of this series of presentations when we start using options for our portfolio, because we are interested in two numbers: risk and reward. We can do that with an option strategy as well. And then we mix it up and say, how much should I invest strategy A, B, and C? Are they uncorrelated? It will have a dramatic impact on your risk and return ratio as presented to the Sharpe ratio. Obviously, you can go to the man himself, Harry Markowitz. He's written book over book over book over book. And if you're inclined, RI at university, option futures and other derivatives, that's the book everybody goes to when you have questions about the mathematics behind it. But in our modern times, it's fantastic. The internet tells you everything, and you can ask every AI. They can do your portfolio optimization as well, as long as you check that the input they put in there is not rubbish. So you can find a lot of articles on my website. Luckily enough, they're all published in English, because I write for Macro Hive, and you might find that quite interesting. My style of writing is mostly on the funny side, to explain difficult concepts. Have a look if you are interested. And obviously there are links to the videos, and there are a couple of downloads in there, Monte Carlo simulation and a couple of other things. I'd be delighted if you check out what we are doing there. And now I'm going to slip you the evil risk disclaimer. Obviously nothing of this, what I presented to you today, should be construed as investment advice. It is a presentation. It is a presentation on a concept which was developed by very, very, very smart people who got Nobel Prizes for what they did. The financial industry adopted it. So make your own decisions, do your own research. Don't rely on all the things people throw at your way, but you have an idea now about the concept, and this is not how you should invest, what you should do. By no means investment advice. I'm not responsible for what you decide to do. Thank you very much for being my guest today, and I hope you've enjoyed this presentation. The next one, as I said, I don't know when I'm going to publish it, probably in the next 1 or 2 weeks, will be Let's Build a Little Portfolio. And in the meantime, if you like this, I've published a video recently where I talk about concepts which are more interesting for the traders, option traders amongst you. It's about option charm. You might like that. I put it right here. And give me a like, give me a share if you like so, and comment what could be done better, what you want to hear in the future. And I hope I see you soon. Bye-bye.